Everyone is watching the wrong number. Gold just had its single biggest one-day surge in 6 weeks, jumping nearly $100 in a single session on April 14th. Silver exploded over 5% in a single day on April 17th, and every retail investor who sold their gold position somewhere between $4,400 and $4,600 an ounce is sitting right now watching prices recover and telling themselves they will buy back in on the next dip. Stop the madness. You sold the structural floor of the most powerful precious metal setup in 40 years because Iran opened a shipping lane. And now you are going to watch gold go to $6,300 an ounce from the sidelines because you traded a war like it was a weather event. Let me tell you what is actually happening here, what the mechanism is, why Iran is not the story but the trigger, and why the move that is coming is going to be faster and more violent than anything this market has ever produced. Because the arithmetic demands it. It is just math, folks. Here is the paradox that should be burning a hole in every investor's brain right now. The Strait of Hormuz closes on February 28th. Operation Epic Fury begins. The supreme leader of Iran is killed. 100-plus oil tankers are halted. 2 ships are attacked in the Persian Gulf. Brent crude goes from $75 to over $112 a barrel in 3 weeks. This is the single largest energy supply disruption in 50 years. And gold, the so-called financial bomb shelter, the asset every financial commentator on television told you to own before the world caught fire, fell from $5,596 an ounce on January 29th all the way down to $4,428 by late March, down 21% from its all-time high during a war. Then the strait reopens on April 17th and gold surges. Let me ask you something. If gold falls during a war and rises when the war cools, what exactly is it hedging? That is the question every confused retail investor is asking right now, and the answer will completely change how you understand what is about to happen next. The financial media has been running 24-hour war coverage for 6 weeks. Red graphics, dramatic music, experts on television predicting everything from $6,500 gold to the collapse of the petrodollar. And the average retail investor watching all of this did exactly what the financial media conditioned them to do. They bought gold at $5,419 the morning the bombs fell. They bought silver at $95. They loaded up on defense stocks and energy companies at the absolute top of the spike. Then it all fell. Gold went to $4,400. Silver fell 46% from its January high of $113, and those same investors who bought the spike sold at the bottom of the pullback in late March, locking in losses of 10, 15, 20%. Tears don't make you money. Selling at the bottom of a structural bull market does the opposite. Here is what CNBC did not explain, not once, not clearly. The financial press spent 6 weeks publishing headlines about $6,500 gold and $150 silver. And when the prices fell during an active shooting war, they ran articles asking why gold was failing as a safe haven. The question itself reveals that the people writing it do not understand the mechanics. They watch the price. They did not watch the mechanism. And there is a catastrophic difference between those two things. Here is the secret mechanism. Write this down because once you understand it, you will never be blindsided by it again. A geopolitical shock causes an oil spike. Brent crude goes from $75 to over $112 per barrel in 3 weeks. That is the largest energy supply shock in half a century. The oil spike immediately pushes inflation expectations higher, not actual inflation, but the market's forward projection of inflation. Bond traders price it in within hours. The 10-year Treasury yield rises. At its peak during this crisis, it was sitting at 4.39%. A risk-free U.S. government bond paying 4.39% annually with zero credit risk and zero storage costs. Now ask yourself the obvious question. Why would an institutional portfolio manager hold gold, which pays nothing, when the U.S. Treasury is paying 4.39% guaranteed? Some of that capital rotates out of gold and into bonds. Simultaneously, global investors buying dollar-denominated treasuries for safety push the dollar index higher. And a stronger dollar mechanically suppresses the price of gold because gold is priced in dollars. When dollars are worth more, it takes fewer of them to buy an ounce. Oil up, dollar up, yields up, gold down. That is the mechanical sequence. Three headwinds, all created simultaneously by the exact same geopolitical event that was supposed to be bullish for gold. This is not a paradox. It is arithmetic. And here is the critical part that every retail investor missed entirely. This suppression mechanism is not permanent. It is finite. It runs until it cannot. And when it reverses violently because all three headwinds turn into tailwinds at exactly the same moment. Now, the strait opens. Oil drops over 10% in a single session. The dollar index erases all of its Iran war gains, falling nearly 3% from its 10-month high. Treasury yields fall to 4.23%, and the market is now pricing the first Fed rate cut before the end of 2026. Every single one of those three mechanical headwinds is reversing simultaneously, and the structural case for gold has not changed by a single data point. That is why gold surged nearly $100 on April 14th, and silver exploded 5% on April 17th. That is not a new bull market beginning. That is the suppression mechanism releasing its grip on an asset whose structural case was never broken, only temporarily compressed. Let me prove this to you with history, because I have lived through every version of this story. I traded through the 1973 OPEC embargo. I managed capital through the Iranian Revolution. I was in the markets through the dot-com bust, through 2008, through every single crisis in the modern era. And I have seen this exact mechanical sequence play out after every major oil shock without a single exception in 50 years. October 1973. OPEC slaps its embargo on the United States. Oil quadruples from $3 to $12 a barrel. Gold spikes initially, then pulls back, then trades sideways while oil stays elevated and inflation embeds into the system. Most investors conclude gold has failed to perform. They move on to other stories, and then the structural move begins. By 1980, gold had risen 2,300% from its 1971 price, not from the moment of the shock, from the moment the shock proved to be permanent and structural. The Iranian Revolution in 1979, oil production collapses. Oil prices go to levels that seemed unthinkable at the time. Gold does nothing immediately. Then over the following 12 months, gold rises 89%. In the year after that, another 10%. The investors who bought at the panic spike and sold during the pullback missed the entire move. September 11th, 2001. Markets crash, panic everywhere, and then gold begins a decade-long bull run from $250 an ounce all the way to $1,900. That is a 660% move over 10 years, driven not by the event itself, but by the structural monetary response to it. The pattern is identical every single time. The shock creates the mechanical suppression. The mechanical suppression creates the buying opportunity. The structural conditions that preceded the shock determine the size of the move that follows. I have never seen the structural case deviate from the historical pattern in 50 years of watching these markets. 1 + 1 = 2. Now, here is why 2026 is different from every previous cycle. Not because of the war, because of what the war landed on top of. Stack the facts. They are undeniable and they are massive. Fact 1. The United States national debt stands at $39 trillion. The country is rolling over $9.2 trillion in federal debt this fiscal year at rates between 4 and 5%. Annual interest payments on that debt have crossed $1 trillion, more than the entire defense budget. In 1973, the national debt was $500 billion. That is not a larger version of the same fiscal reality. That is a categorically different universe. In 1973, Paul Volcker could raise rates to 20% to break the inflationary cycle created by the oil shock. The arithmetic permitted it because the debt load permitted it. Today, the arithmetic does not permit it. A Federal Reserve that raises rates to 20% against a $39 trillion debt load does not break inflation. It breaks the entire fiscal structure of the United States government. The Fed is trapped, and a trapped Fed means that oil shock inflation, once embedded, cannot be addressed through the same mechanism that resolved the 1970s version. That is the structural reality that J.P. Morgan's $6,300 year-end target is built on. It is not optimism, it is arithmetic. Fact 2, central banks bought 863 tons of gold in 2025. They are projected to buy between 755 and 800 tons in 2026. The pre-2022 average was 400 to 500 tons annually. We have now had 17 consecutive years of central bank net gold buying. JP Morgan calls it an ongoing, unexhausted reserve diversification trend. Here is the context that makes this number staggering. In 1973, central banks were selling gold. Today, the most sophisticated sovereign wealth managers on earth are buying gold at double their historical rate, and they have not slowed despite prices already above $5,000. When Russia's foreign currency reserves were frozen with a keystroke in 2022, every finance minister in the developing world received the same message. Your dollar reserves are not really yours. Gold cannot be frozen. Gold cannot be sanctioned. Gold cannot be printed. That realization has not changed. Turkey sold 60 tons of gold during the Iran war crisis to defend its lira. It sold because it needed dollars in an emergency, not because it decided gold was no longer a strategic reserve asset. When the crisis passes, Turkey will buy again. It always does. Fact 3. Silver has been in structural supply deficit for 6 consecutive years. 6 consecutive years of industrial consumption exceeding mine supply. COMEX registered silver inventory is down 64% from its 2020 peak. China, which controls approximately 60% of global silver refining capacity, has restricted silver exports as a strategic material. And the industrial demand base for silver today is structurally larger than in any previous cycle. Every solar panel requires silver as a conductor. Every electric vehicle requires 60 to 80 grams of silver compared to 15 to 20 grams in a conventional vehicle. Every AI data center, every defense electronics system, every satellite communication network. Silver has no viable substitute in any of these applications. The industrial demand is inelastic. It will not diminish in response to a price spike because the cost of silver is a rounding error in the total system cost of a solar array or an electric vehicle. Silver at $83 today against a January high of $113 is not a broken bull market. It is a retest of structural support inside the deepest supply deficit in the metal's modern history. That is the three-layer structural setup. A fiscal trap that prevents the Fed from addressing the inflation the oil shock created, sovereign wealth managers buying gold at double historical rates for 17 consecutive years, and a silver supply deficit with no supply-side solution in sight. The arithmetic does not permit anything else. Let me give you the framework to navigate what comes next. I call it the 3 phases of the precious metals reset, and every major gold cycle in the last 50 years has followed this exact sequence. Phase 1 is the forced liquidation phase. This is where we were between late February and late March. The oil shock creates emergency dollar demand from energy importing nations. Turkey defends its currency by selling 60 tons of gold, $8 billion in 2 weeks. Russia sells gold to fund a war. Poland debates monetizing 550 tons of reserves for defense spending. The gold price falls. Retail investors see the price falling during an active geopolitical crisis, conclude the thesis is broken, and sell at the bottom. The selling is violent. It is large, and it is, by definition, finite. You cannot sell more gold than you own. Phase 2 is the mechanical reversal phase. This is what we entered on April 17th. The Strait of Hormuz reopens, oil drops, the dollar falls, treasury yields decline. The 3 mechanical headwinds that suppressed gold during the crisis reverse simultaneously. Gold surges, silver explodes. The investors who sold in Phase 1 watch the recovery from the sidelines and tell themselves they will buy back in on the next pullback. The pullback may not come. Phase 3 is the structural bid phase. This is what follows over the next 12 to 18 months. The oil shock has embedded inflation into the system. The Fed remains trapped by the debt arithmetic. Central banks that sold during the crisis, including Turkey, resume accumulating because the strategic logic that drove 3 consecutive years of above-historical buying has not changed. JP Morgan issues its $6,300 year-end target. Wells Fargo lifts its forecast to $6,100 to $6,300. UBS sets its target at $6,200 by September of 2026. These are not retail investor wishes. These are the research departments of institutions that collectively manage more capital than any other entities on Earth. They are not issuing those targets based on the short-term oil and dollar mechanics that suppressed gold during the crisis. They are issuing them based on the structural conditions that those mechanics cannot suppress indefinitely. Listen to me. Here is exactly what you need to watch and exactly what you need to ignore. Watch the 10-year Treasury yield. That number is your single most important indicator. It is currently at 4.23% and falling. When it drops below 3.5%, the opportunity cost argument against holding gold collapses entirely. Institutional capital that rotated out of gold into treasuries during the crisis reverses back. All three mechanical headwinds become tailwinds simultaneously. That is the moment the structural move accelerates. Watch that number every single day. Watch the dollar index, the DXY. It has already fallen nearly 3% from its 10-month high as the Hormuz situation resolves. When it falls back below 97, the primary mechanical suppressor of gold prices is materially reduced. You do not need oil price headlines to tell you this. You need one number, the DXY. Ignore everything else. Ignore the war news cycle. Ignore the daily oil headlines. Ignore the television experts debating whether the ceasefire is real. Ignore the financial media's 24-hour fear machine. None of those inputs determine the structural price of gold and silver. The debt arithmetic does. The central bank accumulation data does. The yield does. The dollar does. Everything else is noise. The investors who bought gold at the 1973 oil shock and held through the pullbacks through the periods when everyone said the crisis was over and gold had failed to perform turned $10,000 into $243,000 over 9 years. They were not geniuses. They were disciplined. They understood the difference between the short-term mechanical price and the structural price. They did not confuse temporary suppression for permanent failure. They watched the structural conditions, not the daily price. In April 2026, those structural conditions are not just intact, they have intensified. The oil shock added an inflation layer on top of a debt layer that was already the largest in peacetime history. The $39 trillion debt load has not shrunk. The central bank buying has not stopped. The silver supply deficit has not resolved. The Federal Reserve's fiscal trap has not opened. Everything that made this the most powerful structural setup in 40 years is still in place. The suppression mechanism ran, now it is reversing. Be disciplined, or the market will eat you alive.